This is Horizon's Middle East and Africa. Our top stories this morning. The higher for longer message from Fed officials hits market sentiment, with Asian stocks falling. A mixed set of Chinese activity data failed to inspire confidence in a quick economic rebound. Property stocks in focus on hopes of further policy support. Plus, we get more from our exclusive interview with JPMorgan's Jamie Dimon. And Red Bull Formula One driver Max Verstappen talks about attracting finance to the racetrack. It's just gone 8 a.m. across the Emirates, 5 a.m. here in the UK. I'm Lizzie Burden in London. We've got a busy Friday show for you coming up today. Happy Friday. Let's check in on those markets for you to kick off the programme. We have seen the risk-on rally post-US CPI kind of losing steam. The S&P 500 yesterday closing down 0.2%. US futures pretty flat at this point, and here in Europe pointing lower. If we flip over to the cross-asset picture, it'll help perhaps to explain why. We had hawkish Fed speak from Williams and Mester and Barkin yesterday, all saying that they need more evidence to show inflation's coming down before rates stop being so restrictive. And that left Treasury yields higher. Now they're pretty steady. The 10-year yield at 4.3%, just lower a basis point. The Bloomberg Dollar Spot Index is a touch stronger, 0.2%. WTI crude on track for a third day of gains, currently trading at $79 a barrel, and Bitcoin back above that $65,000 mark after it halted a decline yesterday in the session. We've not got a lot of data left on the docket after the Chinese data. We'll get to that in a moment. But the main highlight today is, of course, Eurozone CPI, which drops at 10 a.m. London time. But as promised, let's check in now on how Asia markets are faring. Avril Hong standing by for us in our Singapore studio. Avril, what's happening where you are?
Yeah, Lizzie, as you alluded to, it's really about that data down from China today. We got the numbers on retail sales and industrial production, and it's showing a mixed picture of the Chinese economic recovery. A big miss on the retail sales front. That's raising these concerns about supply-demand imbalances, really sending a very sobering message of the Chinese recovery. And this is, of course, at the heart of the matter, related to what we're seeing in the property sector. Despite this week, how we saw the stocks in that sector running up on expectations of policy support, you have these home price data today reminding us that that is still a concern. On top of that, the likes of Morgan Stanley downgrading their outlook for the sector, saying that that plan to kind of mop up excess inventory, that might disappoint. We're also seeing the physical market that hasn't bottomed out. So this is what we're seeing in the macro side of things. Let's flip the board and take a look at what we're seeing in the stock markets as well, because that sentiment really being sapped as that optimism comes off. Remember, earlier in the week, it was really about how these Chinese tech names, so far, most of them showing pretty solid earnings, and then those expectations of policy support for the property sector. But today, it is a pretty negative picture. The Hang Seng that has been running higher for much of this week, erasing gains from earlier on in the session. The Chinese currency also weaker. We're keeping a really close watch on China bonds because we just got that special bond sale of ultra-long government bonds, the 30 years. That is in order to raise funds for government spending. The demand from that has looked pretty solid so far, aligned with the expectations from pre-sale, but we're still seeing the 10-year in China coming under some slight pressure today, Lizzie.
OK, so a pretty risk-off mood in China and more broadly across Asia. Avril Hong in Singapore, we thank you. It's been pretty risk-off in the US. As I say, the rally ending after the US CPI data, and that's partly because of more hawkish Fed speak. Fed officials saying that the central bank should keep borrowing costs higher for longer as they await further evidence that inflation's easing. Let's take a listen to the Cleveland Fed President Loretta Mester, who says she expects price growth to cool at a slower pace than last year under less downward pressure from improving supply chains.
Incoming economic information indicates that it's going to take longer to gain that confidence. So holding our restrictive stance for longer is prudent at this point as we gain clarity about the path of inflation.
And meanwhile, JPMorgan CEO Jamie Dimon says he's more worried about inflation than the markets appear to be. Speaking to us at the bank's Global Markets Conference in Paris, Dimon said that significant price pressures remain in the US economy.
I think the surprise would be higher rates because inflation didn't go down. That inflation's been stubborn, maybe bounces up next year. I think inflation next year may be in the cards. It may have nothing to do with what you're seeing today. So that to me is the surprise.
For analysis, let's bring in Maurice Gravier, Emirates MBD Wealth Management Group CIO. Lovely to have you back on, Maurice. Happy Friday to you. We've had this week of economic data, and to you, out of China and the US. I wonder whether it changes your view on when the Fed's going to start cutting interest rates.
Sorry, I didn't hear you. Apologies.
I wonder whether all the eco data that we've had out of the US this week changes your view on when the Federal Reserve is going to start cutting interest rates.
Thank you very much. Sorry for that. Actually, it doesn't change our view at all because market expectations for the Fed are very volatile, but actually the Fed is not that much, and we still believe that there will be 2 rate cuts from the Fed starting in September. The CPI report was a relief for markets because disinflation is back, but it wasn't an absolute surprise because it was basically in line with consensus. What is more interesting is to look at the CPI with the retail sales that were flat and not rising anymore, so you can hope for some normalization of inflation. Still, I agree with Jamie Dimon. Inflation will probably not reach the 2% mark, and we think that the Fed will cut anyway before reaching this 2% mark. The economy is softening. Disinflation will continue, but not in a straight line and with volatility.
And what about the ECB? June is well telegraphed for the start of rate cuts, but what about beyond that? Should they be hurrying up, even considering half-point moves?
Yeah, the ECB is in a different situation because we see signs of improvement. And by the way, that's why we're overall constructive. We see a more balanced activity picture globally with the US slowing and the rest improving. Still, in the Eurozone first, the core CPI is at 2.7, not 3.6, so it's much lower. And then you have mountains of debt, and probably the activity is more vulnerable and fragile. So they have telegraphed this move in June. They will do it, and I think that they will continue because just also the level of public debt is a concern, bigger concern in the Eurozone, where they don't have the privilege of having the world's reserve currency. So we think they will cut in June and probably continue. Yes.
And at the last ECB presser, Christine Lagarde was asked a lot about the impact of diverging from the Fed on the euro, and then that currency weakness potentially feeding back into euro area inflation. I wonder whether that's an irrelevant concern if you transpose it onto the Bank of England and weakness in the pound.
The Bank of England is, I think, it will probably be the most rational of the three. We have seen that they have opened the door a bit wider to rate cuts, which makes sense. Again, it's not that just about inflation, and all the central banks are more balanced now between inflation and growth. For the Bank of England, it's also about the fact that the unemployment rate has risen to 4.3% now. So they will cut. I think they are the most rational. They will be the most data-driven. And our view is that somewhere in the summer we will have a first cut, but they will probably not telegraph a series of cuts. They will be data-driven. That's also the privilege of having your own currency compared to the Eurozone, which is a collection of countries.
I'm sat across the road from Threadneedle Street, Maurice. I can hear them cheering that you've said they're the most rational of the major central banks. You mentioned volatility. Of course, we have been in this data-dependent zone the whole time, but as we get towards the central bank pivot, there's even more attention paid to every single data release. How much more volatility are you expecting?
That's a very interesting point. One of the cornerstones of our view for the year is that central banks have much limited space for action, and they should have less impact on market. I know it's not what it looks like, but we believe that markets are driven by fundamentals. And it's theoretically beautiful, but factually you are super volatile from one data point to another. And I'm not even mentioning the tail risks that we have from geopolitics and politics. So yes, we expect huge volatility to continue. However, if markets are driven by fundamentals, and you can see the hierarchy of asset classes this year, it's interesting. You see bonds being down, but gold being up, and you see China outperforming the other markets. These are fundamental moves, and fundamentals are reasonably constructive. So we are reasonably constructive, but expect lots of volatility because it's not anymore about just central banks being binarily positive or adverse.
Well, let's talk about those tail risks from geopolitics. We played a bit of that Jamie Dimon interview. He said that geopolitics could become the main stress. What's it going to take for markets to care more about the geopolitics?
Yes, absolutely. Sometimes geopolitics don't matter that much for markets, like it or not, and sometimes they do. And currently there are reasons to matter, especially as they are intertwined with the U.S. presidential election, which is extraordinarily open, with a rather thin margin between the two candidates. And this debate happening so early at the end of June. What happens if among the two unpopular candidates, one really loses the debate? Does it compromise its chance to be on the ballot? So it's if you combine the two, the fact that you have U.S. election with two candidates having different views of the role of the U.S. in the world and the hot geopolitics that we have now, yes, it's a good time to think about tail risk. You don't manage your portfolio on a daily basis based on tail risk, otherwise you don't do anything. But it's good to keep a bit of gold and cash somewhere in the portfolio.
All right, Maurice Gravier, Emirates MBD Wealth Management Group CIO. Lovely to see you on this Friday. And we're going to continue our conversation about geopolitics next. Chinese President Xi Jinping and Russia's Vladimir Putin have pledged to strengthen their ties, the bromance in Beijing carrying on. They've also been warning about growing nuclear tensions between rival powers. So we'll bring you that and more next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in London. Let's get back to the geopolitics now. Chinese President Xi Jinping and Russia's Vladimir Putin have pledged to intensify cooperation against what they call containment by the US. Speaking after the leaders met in Beijing, Xi also outlined his position on the war in Ukraine, calling for a negotiated political solution.
China and Russia agreed that a political solution to the Ukraine crisis is the right direction. China's stance on this is consistent and clear.
For analysis, our Asia government and economy correspondent Rebecca Chung-Wilkins joins me now for more. Rebecca, the bromance continuing. It's significant that this is Putin's first trip of his fifth term abroad, that he goes to spend it with Xi. We know that Putin wants China to replace Europe in terms of energy trade, tech and financial markets. But how realistic does this crusher plan look post this trip?
Yeah, I think the main sort of characteristic, I suppose, of Chinese support so far for Russia's war in Ukraine is that they have sort of tried very carefully to fall short of provoking the kind of very sweeping sanctions that we've seen taken against Russia by the US, by various European powers and so on. And so while China is providing a lifeline economically speaking, so for example, they are the main source of trade and investment for Russia. They are buying up cheap Russian energy. They are also providing Russia with white goods, everything sort of like mobile phones, washing machines, even cars, things that Russia's no longer able to access from other markets because of those sanctions. So we do see this critical role, but in practical terms, it's really unlikely that we see something much deeper or much more expansive. We did have this trade agreement for more deeper cooperation between China and Russia. We'll wait to see some of the details of that. But trade has already been somewhat stressed between the two, it appears, because of some of those threats of US reprisals for, allegations around China's support for various parts of Russia's industrial war machine. So, for example, trade between China and Russia actually fell in March. It fell for the first time in 2022. So, in some ways, we might see China and Russia trying to repair, trying to reinstate some of those boundaries. But there are these other constraining factors around sanctions that do create limits for Beijing.
Yeah, that stronger united voice against the US really notable out of this trip. Where does it leave, though, China's support for Russia's war in Ukraine in practical terms?
Yeah, I think that's sort of a key issue. Putin, on the one hand, clearly wanting much deeper and persistent support, but China is also balancing a whole other diplomatic dilemma, and that is that while Russia, on the one hand, is its most important partner in building the sort of so-called multipolar world, that pushback against what they call US containment that you refer to, in practical terms, China does not want to be lumped in or bridged alongside Russia. It does not want to invoke the sort of financial isolationism that Russia has been hit with as a result of its invasion. So it is a very tricky dilemma where globally, on the one hand, while Russia is clearly a critical, important geopolitical and diplomatic partner, on the other hand, Xi Jinping does need to put a little bit or just enough space between the two. There's also a distinction, I suppose, that's useful to make between Putin and Xi Jinping, the relationship, the personal relationship. They've met more than 40 times. As you mentioned at the outset, there's sort of somewhat of an informal tradition that has emerged between these two leaders to visit their respective counterparts' countries, the first overseas trip after beginning a new presidential term. They've celebrated birthdays together. But there is a distinction between the sort of very robust personal ties that the two leaders seem to exhibit versus the broader and somewhat sort of contradictory or somewhat strained national interests of these two countries, particularly as China is on the one hand also trying to sort of smooth over relationships with Europe, with the US, to try and encourage them to stop kind of pressing forward with this move to diversify away from China's own economy. So a lot of domestic interest there that Beijing is trying to navigate as well.
Oh, to be a fly on the wall of those conversations, our Asia government and economy correspondent Rebecca Chung-Wilkins, as near as we're going to get to that fly on the wall. We're going to continue talking and thinking about geopolitics next. We'll bring you more of our exclusive interview with Jamie Dimon, the JPMorgan CEO out of Paris. He wasn't just talking about rates, he's also got concerns about geopolitics. So that's next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in London. Now, the JPMorgan CEO Jamie Dimon says the US has to stay engaged with China. Speaking to us at the bank's Global Markets Conference in Paris, Dimon said Washington and Beijing have common interests and are not natural enemies.
So the geopolitical situation is very tense because of Ukraine and Russia, Iran, the terrorist activities in Israel, North Korea, nuclear blackmail. We've never had nuclear blackmail before, and this is, of course, affecting our relationship with China. And, you know, it's going to be hard to have a great relationship with China as the Ukraine war is on. We're kind of on different sides of that, and put Taiwan aside. Having said that, I think it's the right thing for America to fully and deeply engage with China, you know, competitively. You know, every nation is going to do what's in their own interest for national security. So should America. We should define that fairly and properly. If there's unfair trade, you know, negotiate that or do whatever you need to do. But the engagement is the right thing to do. China is not a natural enemy of the United States. They have a lot of their own problems. So, you know, to me, we could work together as best we can. And then we have common interests: climate, anti-nuclear proliferation, anti-terrorism.
But what does it mean for a bank working in China, actually, given all of this volatility?
They're cautious. I mean, you know, China, if you look at China from a risk-reward basis, it used to be very good. It's not so good anymore because all these things can go wrong. And remember, we bank, I mean, I've got the number, but 1,500 multinationals in China. They're not leaving China, so we're going to serve our clients there. We're just much more cognizant that the risk is higher. And I put Hong Kong in that bucket, too. You know, we kind of look at China, Hong Kong as one at this point from a risk standpoint.
What does the Trump administration mean for the U.S. economy?
I don't know. You know,
why? Because it's unpredictable, or because we're too soon to actually trying to figure out the policies that he would put in place?
So if you look at history, who was elected president may not necessarily affect the next year. That's kind of like we're a big tanker and that's going to happen. I think the much more important thing is what we do in the geopolitical situation. You know, I've always been quite clear that American leadership is provided to keep the world free and safe for democracy. And that means economic alliances, which includes trade, by the way. I think we should spend more time in trade. It means NATO. It means that Russia should not win in Ukraine, because if they do, I think it can tear asunder this Western world.
I know you've ruled out being Treasury Secretary.
Yeah.
Why? What would it take to get you into politics?
I don't think I'm suited for politics. I love my job, and so I'm not sure I want to do something like that. And I can hopefully.
But even if you got the call, would it be hard to say no?
I don't know. Probably yes. I love my job, and I have no interest in leaving or doing anything else.
So that was the JPMorgan CEO, Jamie Dimon, wrapping up a week of excellent interviews with the biggest names in banking this week, and not quite sharing the optimism of Bank of America's Brian Moynihan and David Solomon at Goldman Sachs, perhaps. But now for a look at some of the other stories we're following this morning. China sold a record amount of Treasury and US agency bonds in the first quarter, totaling an estimated $53.3 billion. Beijing's investments in the US are garnering renewed investor attention amid signs that tensions between the largest economies in the world may yet worsen. Earlier this week, President Biden unveiled sweeping tariff hikes on a range of Chinese imports. Elsewhere, the International Monetary Fund has criticised the aggressive tariff hikes on some Chinese goods, including electric vehicles. The fund says the US economy would benefit more from open trade. The IMF has been stepping up its criticism of its biggest and most influential shareholder over surging debt levels, trade restrictions, and even the currency impact of tight Fed policy. And the US has finished building a floating pier that will help bring more aid to the Gaza Strip. The Pentagon says hundreds of tons will begin to flow over the pier in the coming days, with much more on its way by sea. The Biden administration announced back in March that it would build a dock to alleviate the humanitarian crisis, and the situation has only grown worse since then, with the UN World Food Programme saying in a post on X that the threat of famine has never loomed larger. Those are just some of our top stories this morning, and coming up on the programme we're going to take a deeper dive into commodities. Gold losing its shine as demand for silver increases, and we'll look at the drivers of the commodity rally next. But just a quick check on the markets. You've got Asian equities broadly in the red this morning, the Topix and the Hang Seng bucking that trend, but futures on both sides of the Atlantic pointing to a lower opening this morning. The Nasdaq futures just in the green, but really that post-CPI risk-on rally having petered out. More next. This is Bloomberg. This is Horizon's Middle East and Africa. Our top stories this morning. The higher for longer message from Fed officials hits market sentiment, with Asian stocks falling. A mixed set of Chinese activity data failed to inspire confidence in a quick economic rebound. Property stocks in focus on hopes of further policy support. Plus, Red Bull Formula One driver Max Verstappen talks to us about attracting finance to the racetrack. It's just gone 8:30 a.m. across the Emirates, 5:30 a.m. here in the UK. I'm Lizzie Burden in London. Good morning, happy Friday. Let's check on these markets for you, because it seems the risk-on rally that we had post-US CPI is petering out somewhat. You had the S&P 500 closing down 0.2% yesterday. US futures now pretty flat and pointing even lower here in Europe. If we flip over to the cross-asset picture, perhaps it'll help to explain why, because we had that hawkish Fed speak from Williams, Mester and Barkin yesterday, all of them saying we need more evidence to show inflation's coming down before rates can be cut. And that left Treasury yields higher, now pretty steady. The 10-year yield lower a basis point at 4.37%. The Bloomberg Dollar Spot Index is a touch stronger, and you're looking at WTI crude at $79 a barrel there, on track for a third day of gains. Just a quick check on Bitcoin. We're back above the $65,000 mark. It halted a decline in yesterday's session, and it's back on the up today. We've not got loads of data left on the docket today. We've had the China numbers already, as delivered to us by Avril Hong. But the main highlight on the docket is the Eurozone CPI. That's at 10 a.m. London time. But let's get back to Avril. She's on standby for us in Singapore with an update on equities. How are they faring, Avril?
Yeah, Asia stocks are in negative territory today, Lizzie. This is the unwinding of expectations of Fed rate cuts, pressing pause from what we saw earlier in the week. And that's actually playing out not just in stocks, but also on dollar yen. Remember, against the backdrop of those lower US yields, we actually saw dollar yen tracing that 153.6 level thereabouts. But today we're seeing that weakness coming through. It's not just the Fed narrative, though. It's also given the backdrop of the BOJ keeping the bond purchase amount today unchanged. And this is across the curve, despite a move on Monday to reduce the purchases in the 5 to 10 year zone. So that seems to be causing traders to temper some of their expectations that the BOJ will reduce its bond purchases eventually. That's what we're seeing in currencies. Let's take a look at what we're seeing in the stock market, because as I say, it is risk off, and we're seeing the benchmarks in the region mostly lower. Hang Seng, I want to highlight what we're seeing here because we saw declines earlier after the China data dump, but despite the big miss in retail sales, we're seeing those gains now, and I think it really speaks to how sentiment-driven the Hong Kong markets have been of late. Australia's benchmark also well into negative territory, but bucking the trend are the miners, because don't forget, we saw industrial production in China accelerating. That's supposed to be good for demand for products such as iron ore, Lizzie.
All right, Abel Hong in Singapore, we thank you for that update. And I want to dive deeper now into commodities because they're ending the week broadly higher. WTI, as I say, climbing in today's session, on pace for a third day of gains, and gold slightly higher after yesterday's drop. Earlier this week, a key gauge for raw materials prices rose to the highest level in more than a year. And so to pass why, we've got our Bloomberg's commodities reporter, Martin Ritchie in Shanghai. Martin, raw materials have been on an absolute tear this year. Just break down for us what's going on here. What's driving this rally?
Well, to be honest, if I was to break it down into one major thing, it's about metals. If you look at gold, you know, not far from a record high. Copper in New York at a record high. Silver rallying more than 25% this year. All the other base metals doing relatively well. And if you compare that with other areas like energy, like the agriculturals, it's just much stronger. So what's really carrying that broad commodities index up higher is really the metals, and that's a function of a few things. You know, there's anticipation that the Federal Reserve is going to cut interest rates, which tends to make people think there's going to be better demand around the rest of the world. We've had reasonably healthy demand in China, despite all the noise about weakness in China's economy. There are areas of growth, and in things like copper, you've got supply problems as well. So all of this is coming together to make metals very strong, and that in turn is making them outperform.
And you mentioned the impact of the Fed on gold, but actually, is it silver that we should be watching?
Yes, silver has become one of the strongest commodities this year. Look, gold and silver do tend to move rather in tandem. So if you have a big move upwards in the price of gold, silver does tend to chase it. People do try to get into that precious metals space. Silver has some other things going for it, though. Its use in industrial applications is rising. And again, as I mentioned with copper, there are growing deficits. That's, you know, growing supply shortfalls around the world of silver. So that's also pushing up prices as well.
And just broadly zooming out back to that Bloomberg Commodity Spot Index, how much room do you think there is left for this rally to run? Because we're not quite at the pandemic peak yet, are we?
No, not quite at those levels yet. And I think to reach those levels, you would need to see the other areas besides metals really take a bigger leap up. So that would be, you know, things like, especially like oil, and in the crop sector, things like soybeans and corn, etc. But it's really oil we're looking for, and that doesn't look like it's growing really rapidly anytime soon, until you get a much bigger broad-based economic recovery, I think.
Yeah, which brings us back kind of to the geopolitics, as we were discussing with Maurice. Gravier earlier, just waiting for markets to take more notice of the geopolitical story. Bloomberg's commodities reporter Martin Ritchie in Shanghai, lovely to have you on the programme. Now, as we race back towards the weekend, let's turn to the racetrack. The Formula One driver Max Verstappen telling Bloomberg's Jason Kelly that the sport needs to consider different ways it wants to grow and how to keep fans engaged.
It depends how you want to attract fans. Like, you can attract it, of course, in very different ways, right? You know, from the entertainment side or actually the performance side of things. And of course, you know, the sport has been growing a lot lately, probably from, you know, more the entertainment side. But, you know, you also need to question, like, what you actually want, because I think it's also very important to keep, you know, the real die-hard fans, you know, really engaged. But you know, these kind of things, at the end of the day, like, you know, I'm the racing driver. I'm very focused on my performance. And, you know, that's already taking a lot of my time, you know, trying to just be on top of my game, you know, being, you know, in touch with my team, what we can try and improve. And, you know, to be honest, those kind of things are not really going through my mind a lot. You know, how should I grow the sport? I mean, that's not up to me. I'm not, you know, also the shareholder of the sport. You know, I'm just here to try and win the races.
That's a fair point. And obviously the commercial success does, as you rightly point out, rely very much on success on the track. No one would question your success on the track. It's worth pointing out that obviously, you know, there's going to be a big change with Adrian Newey leaving. What's your confidence level, I should say, about that side of the equation moving forward, ensuring that you can stay competitive on the track?
Yeah, I mean, it's of course, you know, it's been you know, quite a change, I guess, but also a shame that, you know, Adrian will be leaving, because I think it would be always nice for him, you know, to be part of what we are doing. I mean, he's been incredibly important for us, especially from the start of Red Bull Racing, I would say. And yeah, I mean, at one point, you know, you have a lot of good people in the team, a really strong technical department. That I trust in as well, you know, for the future. So naturally, the confidence is very high and very excited for the coming years as well. But yeah, would it have been nice for Adrian to be around as well and see that? For sure. But at the end of the day, you know, when people want to maybe seek new challenges or whatever, you can't stop that.
The man's here to win. What more do we need to know? Formula One driver Max Verstappen there. Now, for a look at some of the other stories we're following this morning, Bloomberg has learned that top HSBC holder Ping An is weighing options to reduce its 8% stake. Sources tell us that options include further on-market share sales or divesting to a sovereign wealth fund in the Middle East. We're told Ping An board members are currently visiting the Gulf, but it's unclear whether formal talks have yet started. In other news, Goldman Sachs has clinched a $43 billion mandate to invest pension fund assets for parcel delivery company UPS. It's one of the largest deals of its kind, and one forecast says the outsourcing of corporate pension fund management is set to grow more than 10% annually over the next 5 years. Elsewhere, a US judge has ordered Jane Street to detail a secret Indian options strategy the firm alleges 2 former traders took to their new jobs at Millennium Management. It's facing a deadline next week to provide specifics about the information it alleges was stolen. Millennium and the 2 ex-traders say there were no secrets and accuse Jane Street of bringing vague claims in bad faith. And investors are warning that TSMC's stock surge may hit a regulatory roadblock. Funds governed by restrictions on single stocks cannot add more TSMC equity and may even have to sell after this year's outsized gains. BNP Paribas says European regulations which cap single stock exposures to 10% mean it's now looking at other names, 1 or 2 generations behind TSMC's technology. Those are some of our top stories this morning, but coming up next, we'll bring you a deep dive on Djibouti. It's walking a tightrope, the tiny East African country really trying to maintain its neutrality in the Red Sea shipping crisis. We'll have more on that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in London. Now, the focus of the show really has been geopolitics, and we'll take a different angle on that now. And we'll go to Djibouti, the tiny East African nation located at the point where the Red Sea meets the Gulf of Aden. Djibouti's government's warning Washington not to use its territory to confront Houthi militants who've been attacking commercial ships in the Red Sea. And it's really taken on an increasing significance given all of the cross-currents recently. For more, we can join Bloomberg's Ondiro Oganga in Kigali. Ondiro, just for anyone who's not familiar with this story, explain for us the significance of the port of Djibouti recently and how it's led to the unrest in the Red Sea.
Lizzie, you cannot talk about Djibouti without mentioning its strategic location. This is a country that is located at the tip of the Arabian Peninsula, 16 kilometers away from Yemen. And it's on the Gulf of Aden. And this is on a major shipping route. Ships are going back and forth from the Suez Canal. So it's very strategically located. It's also attracted several military bases from the US, France, Italy, China, and even Germany. And due to the unrest in the Red Sea, it has been an economic boom for them. Right now, there's something called transshipment, where bigger vessels, particularly from Asia, are docking there and loading their vessels on smaller, or rather loading their containers on smaller boats. And according to the chairman of the Ports Authority, their revenue is going to increase by a third, from $450 million to $600 million. And what they're saying is, we're doing good business on the bad luck of others. And this port is very significant to Djibouti because, together with roads and other transport logistics, they account for 80% of growth. This is a very infrastructure-driven economy.
Yeah, it feels like if countries don't have bases in Djibouti, they want them. So how is Djibouti navigating that tightrope of neutrality with all this geopolitical tension going on?
You put it really well, Lizzie. It's a tightrope because neutrality is very difficult amid geopolitical tension. But Djibouti took a very hard decision by saying no to the U.S. when they requested to launch operations against Houthis from their bases in Djibouti. What the Prime Minister said is, quote, "We do not want to be brought into your war." But in exchange, they allowed them to launch defense operations. So if the Houthis attack first, then these countries have the right to defend themselves. And the U.S. Department of Defense says that what they're doing in the region is just to bolster deterrence, but also praise Djibouti, saying that they're a very able and willing partner in fighting extremism in the region. And this conflict is also a tightrope, like you mentioned, because despite the fact that there's a war in Gaza that has left nearly 35,000 people dead, Djibouti has quietly allowed naval vessels from the EU mission with orders to protect cargo on the Red Sea to dock, refuel, and get repaired from the damage that they might have sustained.
So they don't want to be part of the war, but how have operations changed since the Houthi attacks?
It's day and night, because initially what they were dealing with is just people and drug smugglers. Remember, despite being very strategically located, they're neighbors with Somalia, which is fighting Islamist insurgencies, and Ethiopia, that had a civil war for nearly 2 years. So these are the challenges that they had to contend with. Right now, their rescue operations is with vessels that are in distress. Most recently, there was a vessel carrying 21,000 tons of fertilizer that was hit and it was sinking. And when the captain called for help, we saw this Djibouti crew launch rescue operations, and in 24 hours, all the 24 crew members had been rescued. And also, this defense operations being launched from Djibouti is helping ensure that there's still flow of goods along the Red Sea and reducing the time that could have been used to reroute to the Cape of Good Hope.
OK, Bloomberg's Ondiro Oganga, we thank you for that excellent reporting. And it is the big take this morning. If you're grabbing your morning coffee after the programme, I recommend a read. It really does join together the dots on this fascinating subject. Coming up, space satellites are transforming global communication, and Bloomberg Originals has been exploring Elon Musk's Starlink and the consumer space race. We'll bring you more on that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in London. Let's turn now to space satellites. Elon Musk's Starlink transforming communications across the globe. And Bloomberg Originals has been looking at how its dominance is sparking government scrutiny and encouraging deep-pocketed rivals.
The largest single constellation of satellites orbiting our planet is run by a mercurial individual who needs no introduction. It's this guy. It achieves this by maintaining a vast relay network in low Earth orbit. That's the area higher than a jetliner, but below a GPS satellite.
Right now, Starlink has more than 5,600 satellites in orbit.
And it accomplished all this in less time than it took James Cameron to make a second Avatar movie.
At one point, SpaceX envisioned launching up to 42,000 satellites.
But this speed and relative success has raised eyebrows, concerned ones in government, and excited ones in the boardrooms of potential rivals.
It's essentially a company trying to disrupt a somewhat complacent marketplace.
And you can catch the full Bloomberg Originals episode on Bloomberg.com and on YouTube. Speaking of reaching for the stars, I've had Saudi on the brain this week because the UK Deputy Prime Minister Oliver Dowden and a delegation of 450 have been in Riyadh trying to shore up investment ties both ways. And so let's zoom in on Saudi now, because its biggest listing of the year is drawing really massive demand. And we can get more from Farah El-Barawi now from Dubai. Farah, you're our equities reporter. You've been tracking the details of these IPOs, quite a flurry of them in recent weeks. What are the details on this latest one, and when's it going to go public?
It's a flurry indeed, Lizzie. So just looking at Fakih Hospital, which is set to be the biggest listing in the kingdom so far, they got demand of $91 billion for their listing, making them oversubscribed by 119 times. So really just massive demand from investors in Saudi Arabia and internationally for this company, and generally new companies, and specifically new sectors, or rather sectors that don't make up too much of the benchmark Tadawul All-Share Index. Fakih and the founding family are set to raise about $763 million from this listing. And we do know that the retail investors can subscribe to the offering from May 21. So we will get the listing date sometime close to that date, but we're still just watching out for this company that listed at the top end of the range, just highlighting how demand continues to be incredibly strong in Saudi Arabia, with the CEO of the stock exchange over there telling Bloomberg TV just last week that they have more than 10 companies in the pipeline just in the near future alone.
OK, and what other listings then are you watching in the kingdom?
Absolutely. So one of those is actually going to be Rasan, which is an information technology company. And that's what makes it quite interesting, because that will be one of the first fintech companies to trade or go public in Saudi Arabia. So they are currently in book building process, and for institutional investors that ended yesterday, the price ranges between 35 riyals to 37 riyals, and there are more listings on the horizon. One of them is NUPCO. Bloomberg did report that Saudi Arabia's sovereign wealth fund invited banks to pitch for this planned IPO of the kingdom's largest medical procurement firm. Rothschild will be advising the PIF on NUPCO's potential listing, and details on the size and the timings are not yet finalized, but people familiar with the matter have told Bloomberg that it could raise less than $1 billion.
OK, really interesting. Something in that desert air with all this IPO action out of Saudi. Farah El-Barawi, our equities reporter in Dubai. Thanks for staying across it all for us. Now, as we get towards the end of the programme, I want to tell you a story, and it isn't a joke. Just imagine that you're on a red eye from Doha over to New York, from Abu Dhabi over to New York. We're back in 2022. Now, sipping their champagne, eating their peanuts is a who's who of private credit. You've got Apollo's John Zito, Blue Owl's Doug Ostrover, Sixth Street's Josh Easterly, and the hedge fund manager Jason Mudrick. What are they all doing in there? Well, it was the MBE pre-season games at the Etihad Arena. And what's interesting is that nearly 2 years on, they're still making that pilgrimage in order to tap that Middle Eastern money. And it takes up a lot of air miles. So we've been exploring that on Bloomberg in Private Credit Weekly. I encourage you to subscribe to it, but it's a really interesting dynamic that they've been reporting on, not just the back and forth, but also the matchmakers, the local banks who are trying to get in on the trade. That's it from the programme. Just checking in on these markets as we head towards the open. You've got European futures pointing lower, but US futures pretty flat. That rally after CPI kind of petering out as it stands. That's it from Horizons Middle East and Africa. I've been Lizzie Burden in London. Stay with us for Daybreak Europe with Tom Mackenzie next. This is Bloomberg.